and I am going to go through a consolidation question. Before the break and after the break, I'm going to have a look at a current issues question, and that's our evening. I am going to bring the lecture sequence over my shoulder. I'm going to bring the study planner into focus, and I'm just going to do my usual check you're all there. Here we go. What number am I highlighting in with a rather tiny green dot? Can you tell me what number that is that I have highlighted on the sequence over my shoulder? Yes, indeed. Lovely stuff, guys. And session 3, that is indeed the session. You can see that I'm doing question base and a question called orangutan. My apologies. The question orangutan is no longer called orangutan. It is now been changed to gorilla. The question is now called gorilla and appears in the revision pack. I think I just saw that it was on page 30 of the revision pack. But we don't need to worry about that at the moment. We need to focus our minds on question base. Question base is a P&L question. There are only 2 P&L questions available for us to look at. And just before the break, at the end of session 2, I was talking about the fact that we're going to do one now, and I'm going to set another one as homework. The one that we're doing now is actually the older one. You can see from the reference to being question 4 that it's really quite an ancient question. It's from 2003, but it's a brilliantly written question, and I'm hopeful that if the examiner examines profit and loss report, if he examines comprehensive income statement, he will base it largely upon base. Let me bring up base for us all to look at. So here it is, if I can find it. There we go. Here it is. That's just out of shot, actually. I'll just bring it back down again. So there we go. That's the centrepiece of the examination question. It is in the revision kit. It is question 4. Let me just show you the page number there. So there's the page number there, 25. Fantastic. So we are in the revision kit on page 25. Now, there are parts of this question that are less than perfect, but much of this question works okay. I will talk to you about the parts of this question that are starting to show their age, but otherwise I will heartily recommend this question to you as a question to practice over and over again till they become easy. So let's start with what we're going to be doing. The requirement is for a consolidated income statement, a consolidated profit and loss, but also the adjustment in equity, and we'll see what that means as we work our way through. It's the usual 35 marks of numbers, numbers, bash, bash, bash. So off we go. Back up to the top of the page, top of the question on page 25. We're going to start with the net assets working. We're going to measure the net assets at acquisition. Base, a publicly limited company, acquired 2 subsidiaries, Zero and Black, both public limited companies, on the first day of last year. Usually is with a P&L. First day of last year. The details of the acquisition at the date of acquisition are as follows. And we have ordinary share capital and reserves, ordinary share capital and reserves, and we're going to compare those ordinary share capital and reserves to the fair value of the net assets to give us an FVA. Off we go. Good luck, guys. Enjoy. So here we go. Let's do our net assets working first. Let's do our net asset working first. Great. Here we go. How's that looking? Oh, I see it's defaulted back to fine point. I'll sort that out for us, no problem. Chisel, there we go. Lovely doubly. Question base. There's a couple of marks for your net asset working to get yourself started. Net assets at acquisition at year end to give us the growth, and net assets at acquisition at year end to give us the growth. Why the repetition, you ask me? Well, of course, we're doing one working for Zero and the other one for Black. And I could do with the question actually to my side in paper. So I'll get that in front of me. We said page 25, didn't we? So I've got the original revision kit in paper here in front of me, as you can see. And I'm just opening it up on page 25, so I've got it in front of me like you have. So the share capital doesn't change. It was 350 at acquisition, and it's still 350 now. The share capital doesn't change. It was 200. And it's still 200 now. The reserves, or retained earnings by the modern name, 250 and 150. And then it tells you the fair value of net assets at acquisition. Quite a nice way of presenting the information in order for us to work out the FVA as a balancing figure. So we've got a fair value of net assets of 770. And just next door 400. Quite fond of colours here, although it is slightly naff, but I do like a bit of colour. So this is my book value, as it's called. I'm going to compare it to my fair value to get my fair value adjustment. As you can see, it's 600 compared to 170. Oh, sorry, it's 600 compared to 770 to give an FVA of 170. What I'd like you to do is work out the FVA in the other fella. Over to you guys. Tell me the FVA in black. Well done, Mandeep. Very good, very quick. And the rest of you guys right up with him. Excellent work. Well done. So we compare the fair value to the book value to discover that there's a balancing figure of 50. Now I know this sounds completely insane and barely forgivable, but back in 2003 the examiner forgot to say what the FVA was on. So what did he assume? He assumed a land. And he is very fond of FVAs on land. They usually are on land. But forgetting to say was completely insane. How did that happen? Well, it was just one of those things that happened in 2003. It will not happen in 2014. The examiner will tell you what the FVA is on, and it probably will be on land. So the FVA is unchanging. And the FVA is unchanging. And as you can see, all we need now is the pink fella here for the retained earnings at the current year end. Okay, we've started. Great. Now, let me introduce you to the body of the question. All modern questions are written in a certain way, and they're written with paragraph 1 is about subsidiary 1, paragraph 2 is about subsidiary 2, and paragraphs 3, 4, 5, 6, 7 are parent paragraphs. So paragraph 1 is subsidiary 1, paragraph 2 is subsidiary 2, and all the other paragraphs are parent paragraphs that are superimposed later. Now, this is a question that the examiner wrote before he fully developed those ideas. The ideas are partially developed even in this question, even though it's ancient. It's an idea that he's been rock solid with since 2007, but he's been pretty solid with since 2005. So he was already starting to formulate the ideas of, you know, to make an examination question manageable, you have to have a certain consistency in the way that you present your information, and therefore the examiner has had that consistency since 2007. But this predates that. Still a brilliant question, but it does have one slight problem. Paragraph 1 is subsidiary 1. Paragraph 2 is subsidiary 2. Paragraphs 3, 4, 5, 6, 7 are parent paragraphs, but then he goes back to the subsidiaries with paragraphs 8, 9, 10. Can you see that? He goes back to the subsidiaries with paragraphs 8, 9, 10. You will not have paragraphs 8, 9, 10. The information will be subsumed into the appropriate paragraph.